Elon Musk does something no traditional investor is taught to tolerate. He burns capital, not accidentally, not inefficiently, but deliberately. He builds factories before demand exists. He overinvests in technologies before the economics make sense. He accepts losses that would get any other CEO fired. And yet, somehow, the companies that survive this fire don't just recover. They dominate. This isn't recklessness. It's a different theory of power. And this is dark alpha, where value meets velocity. If you believe capital efficiency is the highest virtue in business, Elon Musk looks irrational. If you believe return on invested capital is the ultimate scoreboard, his early years read like a warning label. Billions lost, timelines missed, margins sacrificed, near bankruptcies stacked on top of each other. But here's the uncomfortable reality. Some of the most strategically important assets of the 21st century were built by ignoring short-term capital discipline entirely, not by optimizing spreadsheets, but by overwhelming systems. This matters now because capital is no longer scarce in the traditional sense. Information is abundant. Talent is mobile. Software is cheap. What's scarce is industrial momentum. The ability to bend supply chains, labor markets, regulators, and competitors into a new equilibrium before anyone else can react. As an investor, misunderstanding this distinction is expensive. As a founder, it can be fatal. As a decision-maker allocating capital over decades, it creates blind spots that look like prudence until they look like irrelevance. If Musk's approach is wrong, it's one of the most destructive misallocations of capital in modern history. If it's right, then much of what passes for financial discipline is actually strategic weakness disguised as wisdom. And if you don't understand the difference, you're not just missing upside. You're misunderstanding how dominance is built in an era where technology compounds faster than capital statements can capture. Traditional finance was designed for a world that moved slowly. Factories took years to build. Distribution scaled incrementally. Consumer behavior changed over generations, not product cycles. In that world, capital efficiency was survival. You preserved cash. You minimized waste. You protected margins. The math worked because the environment was stable. But technology broke that assumption. When learning curves steepen, when software eats fixed costs, when manufacturing itself becomes programmable, time becomes more valuable than capital efficiency. This is the critical shift most models miss. Capital efficiency assumes competition happens inside known constraints, known demand curves, known cost structures, known timelines. Musk operates as if those constraints are malleable. Instead of asking, what's the most efficient way to serve today's market? He asks, what scale forces tomorrow's market to exist? That difference sounds philosophical. It's actually mechanical. At Tesla, capital was deployed not to maximize near-term margins, but to collapse the learning curve of electric vehicle manufacturing. At SpaceX, money wasn't spent to optimize launches. It was spent to make reusability inevitable. At Neuralink and XAI, capital isn't chasing revenue. It's compressing research timelines. In each case, the losses aren't side effects. They're inputs. This is where most analysts stop too early. They see negative free cash flow and conclude mismanagement. They see missed guidance and conclude overreach. But Musk's strategy only makes sense if you stop thinking in quarters and start thinking in phase transitions. A phase transition is when a system suddenly behaves differently once a threshold is crossed. Water freezes, networks tip, standards lock in. Before the threshold, everything looks inefficient. After it, efficiency explodes. The risk is obvious. Miss the threshold, and you've just incinerated capital. But the reward is asymmetric. Cross it first, and competitors aren't just behind, they're structurally excluded. This is the frame for this episode. Not whether Musk is reckless or brilliant, but whether deliberately destroying short-term capital efficiency can be the fastest path to long-term technological control. The core idea is simple, but uncomfortable. Elon Musk uses capital not as a scarce resource to be conserved, but as a weapon to compress time. Time compression is the real objective. Every dollar that looks wasted on a spreadsheet is often buying speed, learning, or irreversibility. Let's start with Tesla. In its early years, Tesla made no economic sense. Luxury EVs at low volumes, custom components, manual processes, negative gross margins. A traditional auto executive would have optimized, outsourced, protected capital. Musk did the opposite. He vertically integrated, built factories before demand justified them, designed custom batteries instead of using off-the-shelf solutions. From a capital efficiency perspective, this was madness. From a time perspective, it was acceleration. Every iteration inside Tesla shortened the feedback loop between design, manufacturing, and performance. Every dollar spent internally created learning competitors couldn't buy. This is the first reframing moment. Capital efficiency optimizes known processes. Musk invests to discover unknown ones. Discovery is expensive, but once discovered, it compounds. The Gigafactory is the clearest example. When Tesla announced it, analysts mocked the scale. Too big, too capital-intensive, too early. But the factory wasn't about immediate demand. It was about collapsing battery costs through scale and learning. Battery economics follow Wright's law. Costs fall as cumulative production rises, not as factories become efficient, but as experience accumulates. By overbuilding capacity, Tesla moved itself down the cost curve faster than the industry. The losses weren't a bug, they were tuition. Now look at SpaceX. Rockets were never supposed to be reusable. The entire aerospace industry accepted this assumption. Why? Because reusability looked capital inefficient. Higher R&D costs, higher failure risk, uncertain payback. Musk ignored that logic. He spent years lighting money on fire trying to land rockets. Explosions, delays, public failures. Any publicly traded aerospace CEO would have been removed. But here's the twist. Once reusability worked, the cost structure of launch didn't just improve, it inverted. SpaceX didn't become a slightly better launch provider. It became the only one with a fundamentally different cost curve. At that point, capital efficiency flipped. What looked wasteful for a decade became an insurmountable moat. This pattern repeats. Overinvest early, absorb losses, force a technological discontinuity, then let economics snap into place. The market usually evaluates step 3 without understanding steps 1 and 2. Now consider Starlink. Billions spent launching satellites before profitability. Massive upfront capex, regulatory risk, uncertain demand. Again, capital inefficiency everywhere. But Starlink isn't about broadband margins. It's about owning orbital infrastructure. Once thousands of satellites are in place, the marginal cost of serving new users collapses. Competitors face not just economic barriers, but orbital congestion and regulatory friction. The capital burn creates positional dominance. Here's the mini twist. Most people think Musk is taking big risks. In reality, he's often reducing long-term risk by front-loading losses. By spending aggressively early, he shortens the period of uncertainty. Either the technology works and he wins decisively, or it fails quickly. Slow, capital-efficient approaches prolong uncertainty. They look safer but extend exposure. This is why Musk often pushes companies to the brink. Not because he's reckless, because edge conditions reveal truth faster than comfort ever could. Capital efficiency optimizes survival. Time compression optimizes inevitability. And inevitability is where monopoly economics emerge. Now let's introduce the counterweight. Warren Buffett. Buffett represents the opposite philosophy. Capital preservation, predictable cash flows, high returns on invested capital. He avoids industries where technology shifts too fast. He prefers businesses where change is slow and competition is rational. Buffett waits for certainty. Musk manufactures it. Neither is wrong. They operate in different terrains. Buffett's world rewards patience. Musk's world punishes it. Here's the critical distinction. Buffett invests after dominance is visible. Musk invests to create dominance. Buffett buys Coca-Cola because the moat already exists. Musk builds moats by making entry economically irrational. The trade-off is timing. Buffett avoids catastrophic loss. Musk risks it routinely. But Buffett's model depends on stable environments. Musk's thrives in unstable ones. This is why traditional valuation models struggle with Musk-led companies. Discounted cash flow assumes steady-state economics. Musk operates in pre-steady-state chaos. Comparing Tesla's early losses to Ford's margins misses the point. Ford optimized for a mature market. Tesla was reshaping the market. This doesn't mean Musk always wins. Solar City nearly collapsed. Neuralink remains unproven. Twitter, now X, exposed the limits of brute force capital deployment in social systems. Capital can bend physics. It struggles with human behavior. This is the boundary condition. Musk's approach works best where systems obey engineering laws, not social ones. Manufacturing, rockets, energy, compute. These are domains where scale and iteration overpower incumbents. Media, politics, culture, capital alone doesn't compress time the same way. So the trade-off becomes clearer. Buffett optimizes for durability. Musk optimizes for velocity. Buffett compounds capital. Musk compounds capability. One protects wealth, the other manufactures power. The market often confuses these. Investors expect Musk to behave like Buffett. They penalize him when he doesn't. But the mistake isn't Musk's behavior. It's the misalignment of evaluation frameworks. If Musk's model works, the implications are profound. Capital allocation shifts from efficiency to aggression. The winners are those who can afford to lose early. This favors large pools of capital, sovereign backing, and patient private investors. It disadvantages cautious public markets and risk-averse boards. Industries consolidate faster, not through mergers, but through technological exhaustion. Competitors don't die because they run out of money. They die because catching up no longer makes economic sense. If the model fails, the costs are equally severe. Burned capital isn't recycled. Failed megaprojects create dead zones in innovation. Investor trust erodes. There's also a systemic risk. When too many players adopt time compression strategies simultaneously, capital discipline collapses. Bubbles form, coordination breaks. The difference between productive burn and destructive burn becomes visible only in hindsight. This forces a harder question. Are markets equipped to price strategies that intentionally violate their own heuristics? Or will they continue to punish short-term inefficiency, even when it builds long-term control? For capitalism, this is a stress test. If capital only rewards efficiency, it may starve the very projects that redefine industries. If it rewards burn indiscriminately, it invites chaos. The balance is fragile. Musk operates at the edge of that balance. Elon Musk's legacy won't be decided by quarterly earnings or valuation multiples. It will be decided by whether time itself bends in his favor, whether the capital he destroyed becomes invisible in hindsight, absorbed into infrastructures so dominant we forget they were ever optional, or whether those losses remain scars, reminders that speed without restraint can collapse under its own weight. The deeper question isn't about Musk. It's about us, about what kind of capitalism survives when technology moves faster than accounting, when efficiency lags innovation, when control precedes profit, when dominance is built before it's justified. In that world, conserving capital may feel prudent, but it may also be a way of arriving too late. And burning capital may look irrational, until the moment it makes everything else obsolete. That tension isn't resolved here. It's playing out in factories, launch pads, data centers, and balance sheets right now. Quietly, relentlessly. And the outcome will decide who controls the next era of value and who merely watches it form.